Today we have, and we couldn't be more distinguished in that context, Dr. Subbarao, former Governor, Reserve Bank of India, who will speak about his new book, Who Moved My Interest Rate? Leading the Reserve Bank of India Through 5 Turbulent Years. We all have read a lot about this, so we come with some prior information, so it'll be interesting to see the questions. We have, as discussants, eminent people like Subir Gokarn, who's now Executive Director, International Monetary Fund. We have Ninan, Chairman, Business Standard, and Dr. Shamika Ravi, who is not only the person who's responsible, as I said, for this development seminar series, but a very highly informed and deep thinking expert in her own right. So thank you again and welcome. This is the third development seminar. There have been 2 earlier. I don't want to stand between you and this discussion. One was by Dr. Rakesh Mohan, and one was by Sumit Agarwal, Vice Dean of National University of Singapore. So without further ado, the floor is yours, Shamika, and I look forward to a very interesting discussion. Thank you.
Thank you, Harsha. This is first week of Harsha with us at Brookings India, and we have kept him incredibly busy. Thank you so much for the gracious words. Good afternoon and welcome to Brookings India and to the development seminars at Brookings India. We are extremely excited to have Dr. Subbarao speak about his new book, and beyond the rumors and the politics, we are very keen to understand, sir, how difficult it was for you to lead the Reserve Bank of India through the 5 turbulent years, as the book is titled. And to discuss, we have our very own Subir Gokarn and Ninan from Business Standard. Before we start the seminars, I'd like to very politely reaffirm to the crowd that this forum is not to speculate about the appointment for the next governor of the RBI. We really do want to keep the discussion limited and focused to Dr. Subbarao's book. So Dr. Subbarao, you have 25 minutes. Please take it away. Thank you.
Thank you very much, Shamika, and I want to thank Brookings India for inviting me to speak on my book as part of the development seminar series, and I want to thank all of you coming to listening to me. It means a lot to me. I became governor on the 5th of September 2008, and those of you who have some sense of recent financial history will note that date. 5th of September, I became governor. 7th of September, Fannie and Freddie were taken over by the US government. 9th of September, Countrywide came down. 10th of September, AIG came to the brink of a meltdown. 13th of September, Merrill Lynch vanished. 16th of September, the grand finale, Lehman Brothers collapsed, plunging the global financial sector into a near-death experience. So the story going around at that time was that this new governor had come and it brought on the crisis to India. I played along, took that in my stride, and wherever I went, people used to ask me, "So when will the crisis end?" As if I knew. But I used to pontificate and say, that since you people thought I brought on the crisis will end when my term ends. And for good measure, I used to tell them when my term would end. But here's the thing. The week after I left the Reserve Bank, I proved very prophetic. The economy got back on track. Rupee stabilized. Inflation started trending down. Growth started trending up. Very prophetic prediction by me. If there's one prophecy on which I wish I'd been wrong, it was that. But that was not to be my legacy. So as the crisis engulfed the world, engulfed India, I was brought into firefighting, crisis management, even as I was on a very steep learning curve. My leadership was tested, I was challenged, and it was really baptism by fire. Come to think of it, it was not just baptism by fire, but the fire kept raging all the 5 years. Because in the beginning, 2008-9, there was the global financial crisis. 2009 to 2012, there was inflation, not just ordinary inflation, but an extraordinary episode of very stubborn, very high, very persistent inflation. And in the last year of my tenure, 2012-13, we were fighting an exchange rate crisis, part of the taper tantrums. The Chinese were saying, may you live in interesting times. I can't complain on that account because I had my share of interesting times, sometimes more interesting than I had wished. So I'm going to talk today about the three crises: the global financial crisis, the inflation crisis, and the rupee crisis very briefly. First, about the global financial crisis. When Lehman Brothers collapsed, the crisis spread around the world like a wildfire. What started as a bubble in the housing sector of one country first became a global financial crisis, then a global banking crisis, and then a global economic crisis. It is a very frightening situation around the world. It is a very frightening situation here in India. We used to hear stories of storied institutions falling every day. Virtually every big name financial institution was engulfed in rumors of imminent collapse. Trading had come to a stop, prices plunged, markets had frozen. No one, literally no one knew where we were headed. Given the ferocity of globalization, the crisis spread to India as well. We were affected, all our markets, our equity markets, our bond markets, our currency markets, our debt markets, our money market, all of them came under pressure. There was dismay, there was disbelief, there was denial about why India should be affected by a crisis like this. There were many causes for that dismay, denial, disbelief, but the most important was some of the educated people used to think, look, there was the Asian crisis, 97, 98. We were not affected by that. 10 years later, the global financial crisis, why should we be affected? That question was asked because people did not realize, did not internalize how much India had changed in the 10-year period between the Asian crisis and the global financial crisis. In that 10-year period, we integrated very deeply into the global economy, not just by way of trade, not just by way of trade in goods and services, but more importantly by way of finance, so much of financial flows. So whatever happened around the world was going to affect us. Lehman Brothers filed for bankruptcy, I think around 12 noon New York time or so. It was about 9:30, 10 p.m. in Mumbai at that time. But Reserve Bank top management and the entire staff down the line acted with extreme alacrity. By morning 6 a.m. we took action to ring fence the two subsidiaries of Lehman Brothers in India. There was a primary dealer and there was a non-bank finance company. We ring fenced both of them by 6 a.m. the following morning. And during the months of the crisis, we were driven by three objectives. The first was that our financial markets must keep functioning normally. The second was that we must keep the system doused with liquidity, both rupee liquidity and foreign exchange liquidity. And third, credit must keep flowing. And we did a lot of things in pursuit of those objectives, both by way of conventional policies and unconventional policies as well. There were several challenges in managing the crisis. I wrote about them in the book. Here I'm going to talk about only one. That challenge is this: how do I, as a greenhorn governor, lead the Reserve Bank through this crisis? Not just any crisis, but a crisis, an extraordinary crisis, the deepest since the Great Depression. And even veteran central bankers were bewildered, not to speak of somebody, a fresher like me. Look at this. Look at the situation. I was just 10 days old when Lehman Brothers collapsed. I was finance secretary here. Within 24 hours, I flew to Mumbai and became the governor. And the markets did not know me. So they did not know what to expect of me, how I would react, how I would speak. Normally, whenever a governor comes in, there's some adjustment time for the governor and the markets to get to know each other, because the size of the man, learned to understand his personality, his stance, his language, his body language. That accommodation time was not allowed to me or to the markets. A lot of people in the markets were nervous about me, whether this guy does he know what has to be done. The second factor was that my credibility was very low. As I told you, I was Finance Secretary of Centre's governor. The story going around that time was that I was dispatched from Delhi to Mumbai to act in the Reserve Bank at the government's bidding, that I would be pliable, I would compromise on the Reserve Bank's autonomy to implement the government's instructions. Such a credibility crisis or whatever, lack of credibility would have been bad at any time, but at a crisis time it was particularly damaging because as part of crisis management, the markets, including the Reserve Bank, saw me acting very closely with the government. So I was treated as the government's lackey or whatever in the Reserve Bank. At the same time, I was forced to act very closely with the government. This was not unique to India. Everywhere around the world, central banks were working very closely with the governments. But in India, the story was that this new governor had come and he is compromising the Reserve Bank's autonomy and putting the government in the driver's seat. But what was even more worrying for me was my questionable credibility with my own staff in the Reserve Bank. My concern was that what if, like the rest of the markets, rest of the world, they too suspected my credentials. Here again, there was a double whammy because, first of all, credibility was low, they did not know me. And second, we were having to do a lot of unconventional things that the Reserve Bank normally does not do, like open up a line of credit for non-bank finance companies and mutual funds. Also, bring interest rates down. Now, Dr. Reddy, my predecessor as governor, had actually raised the interest rate in the third week of July. And in mid-September or early October, in about a space of 3 months, I was going to reduce rates. And this is a very abrupt shift in policy stance, and for the Reserve Bank staff to digest and appreciate that. So we muddled along, and what's a matter of satisfaction for me, enormous satisfaction for me, that is that in the 100-day evaluation of my governorship, the general consensus was that I handled a very turbulent period with intelligence, professional integrity, and exemplary calm. That's about the crisis. Let me move on to managing inflation. Even as we recovered from the crisis, sooner than most other emerging economies, inflation caught up with us. There were many reasons for that. I don't want to go into that, why inflation was so stubborn, so persistent, and so high. But across the country, there was despondency about that episode of inflation. Because if you throw back to the time before the crisis, we clocked what? In the 3 years before the crisis, we clocked on average 9.5% growth. We thought we were the next growth miracle, and then during the crisis, growth plunged and inflation started going up. Managing this tension between growth and inflation is a challenge for central bankers. It is not unique to me, it is not unique to India. It's a quintessential challenge for central bankers, and we struggle, or central bankers struggle with it all the time, because to support growth, you got to keep interest rates low, but to control inflation, you got to tighten interest rates. In 2009, early 2009, we were celebrating the platinum jubilee of the Reserve Bank, and all of us, the entire top management of the Reserve Bank, we went to Chennai for a town hall meeting. And this is a week before Pongal. And Chennai was in a festive mood, the Reserve Bank was in a festive mood, and we had this town hall meeting on the steps of the Egmore Museum at 7 p.m. and it was a nationally televised show. And we had and there were literally about 350-400 people picked up from the street, as it were, middle class people, low income households people, and there were youngsters, middle-aged people, some old people as well. And there were lots of questions, predictable questions about service in banks, interest rates, deposit rates, etc. And then in the middle of the show, half an hour into the show, I took an instant poll there. So I said, I asked the people there, how many of you want the Reserve Bank to control inflation? Some hands went up, and I reckon that about 50% of the hands went up. Then how many of you want the Reserve Bank to prioritize growth over inflation? Again, some 50% of the hands went up, roughly 50-50 divide. But what struck me, even as I was on that show, in front of all these people, was that the middle-aged people, older people, middle-income people, middle-class people, they were in support of controlling inflation. And the younger people, our young professionals who were still had a long career ahead of them, they were asking for growth. So different constituencies in the country want different things, growth and inflation. I went to Chandigarh and met the pensioners there, Pensioners Association, and asked them, what do you want? Sir, interest rates on deposits are very low, savings rate interest rate is very low. Can you do something to raise it? And within half an hour, I went to meet the Small Scale Industries Association, SME Association there. What do you want? Interest rates are very high. Can you do something to bring them down? So that's the conflict that central bankers have to face. So during my time, as I was battling this growth inflation tension, I was criticized. I was criticized by the hawks for not being hawkish enough. I was criticized by the doves for not being dovish enough. I don't want to go into full defense of what I did or did not do, but I just want to briefly address the issues at that time. From the hawkish side, the complaint or the criticism was that I did not raise interest rates briskly enough, aggressively enough. As a result, inflation had gotten out of control. And in fact, I'd earned a moniker like Baby Step Subbarao because I raised interest rates in baby steps of 25 basis points. But we were acting in real time at that time. If you go back to that time and look at the global situation, the financial crisis was still on. There was a lot of uncertainty, anxiety in the global financial markets, in the global economy. The Eurozone sovereign debt crisis was brewing. And there was concerns about financial stability within India. So to balance the concerns of growth, inflation, and financial stability, people who criticized us criticized that with the benefit of hindsight, whereas we were acting in real time. On the other side, people who thought that I was too hawkish, very aggressive in interest rates, the complaint was that I was killing growth. In fact, not Mr. Ninan's paper, but some newspaper, news magazine, I don't know where it was, I can't recall, had a big banner item with my picture there and it said, "This man killing growth," etc. But the story going around was that the Reserve Bank's tight interest rate policy was choking investment and therefore choking growth. As part of the policy consultations, we consult a variety of stakeholders in the Reserve Bank, including the corporates. I had, in the run-up to one of the policies, not one, but several times, but I'm talking about this particular one, about 20 of the biggest corporates in the country in that meeting hall, and they made their own representation. At some point I said, how many of you want us to cut interest rate next week in the policy? All the hands went up. And he said, how many of you are going to make an investment decision if you cut interest rates next week? Not one hand went up. So it is very clear evidence that it was not interest rate that was the binding constraint choking investment at that time. But I must say that to some extent, data in real time wrong-footed us. It now turns out that growth during that period was actually faster than the data told us in real time. We had in fact a V-shaped recovery. So if we had known that in real time, it's a fair conjecture that we would have tightened more aggressively, but that's all conjecture with the benefit of hindsight. So far I spoke about the global financial crisis. I spoke about managing inflation. Now I'll talk about managing the exchange rate during the taper tantrums. In 2013, Chairman Bernanke of the Federal Reserve made a statement in May 2013 that they were going to taper the quantitative easing that destabilized the financial markets around the world. There was carnage in the external sector, in our external sector. The rupee depreciated by about 17% between May 2013 when he made the statement and September 2013 when I left office. India was part of the Fragile Five along with Brazil, Turkey, Indonesia and South Africa. Why was India bruised so badly by the taper tantrums? Was some adjustment correction in the exchange rate inevitable? Those are important questions. I addressed them in the book. I don't want to go into them here. But all I want to say is that on my watch, during 2012-13, the Reserve Bank had to mount a massive defense of the exchange rate. And I want to talk about only one challenge during that time. I wrote about several in the book, but here I'll talk about only one, which is how do central banks predict market reaction? Everything that a central bank does, its effectiveness depends on how expectations are managed, how markets react. We do something with certain expectation of how the markets would react. But predicting market reaction is very difficult, even in normal times, can be exceedingly complex in crisis times because there is irrational fear, there is self-fulfilling prophecies, etc. Let me give you some examples of the challenges of predicting market reaction. In August 2013, we imposed capital controls. Capital controls were the following. Many of you might be aware that under Reserve Bank regulations, both individuals and corporates can take money out every year. Individuals some $200,000 at that time, corporates about 400% of their net worth. In August 2013, we brought the limits down in order to arrest outflows. The market reaction was swift and brutal. The rupee depreciated by about 3% in a matter of 2 hours. What explains this unexpected market reaction? Capital controls are not new. Reserve Bank has been implementing capital controls all along. My predecessors have done that. But what was so unique, what was so different about this situation that the market reaction was so brutal? We thought about it. The inference we drew was that previously the Reserve Bank typically controlled inflows, but here we were controlling outflows, and the market saw this as a panic reaction. Let me give you another example. In July 2013, we raised interest rates in order to defend the exchange rate. Central banks do not normally use interest rate as an instrument for managing the exchange rate. Normally, at least they don't admit to it. In the Reserve Bank, we've never used interest rate to defend the exchange rate. This is the first time we were doing it. Very extraordinary. And why were we resorting to such an extraordinary measure? We resorted to that first because we got reports that there was a lot of liquidity in the system and that was fueling speculation, especially in the Indian non-deliverable forward markets outside the country. We had to choke liquidity. And second, I thought that this extraordinary reaction would be seen as the Reserve Bank's resolve to defend the exchange rate. Again, the market reaction was unsparing. And that was a time when there was also a lot of concern about growth. Remember, where growth was moderating, inflation was going up, we were talking about stagflation, etc. And the TV channels that night, the newspapers next morning, everyone talked about how this might hurt growth. There was a media conference the next day. I expected the question. Predictably, the first question was, sir, would it not hurt growth? And I thought it was my responsibility to assuage those concerns about growth. So I said, yes, we are sensitive to those concerns about growth. The Reserve Bank will withdraw these measures as soon as the rupee stabilizes. Saying very clearly that we're not happy about it, but we will not keep this measure any longer than necessary, we will withdraw it at the earliest. Again, the market reaction was brutal, and the rupee slipped. Why did that happen? There were two things. The first, people said that at a time when the market was so concerned about the rupee, the Reserve Bank, particularly the governor, should have demonstrated undivided attention to defending the rupee exclusive of all other concerns. And then the second criticism was that the Reserve Bank, particularly I, sounded very hesitant. Some paper wrote that I was very apologetic about defending the exchange rate. As I look back, perhaps there were some communication missteps, but then I asked people, some people like Venu informally, what should I have said? The response was, instead of saying that we will withdraw these measures when the rupee stabilizes, you should have said, we will not withdraw these measures until the rupee stabilizes. Turn around that phrase so to sound more definitive and more assertive. And people also wrote that this governor is not alpha male. It should be more alpha male. Yeah? So what's being an alpha male? I looked up Google. I said, what's alpha male? Very confused about what an alpha male is and what it implies. And even now, I'm not sure whether not being an alpha male is a badge of honor or a certificate of weakness. Let me give you a final example. During the rupee tantrums in 2013, in media conference, I said, what's your exchange rate policy? Now, over 5 years, you're tutored to recite your exchange rate policy even if you're woken up in sleep. So I reeled out a standard policy, which is that we're not targeting any specific exchange rate. We only manage volatility or excess volatility. The market decided from that statement that the Reserve Bank is withdrawn from the market. The governor has withdrawn all intervention. Now, the wording was exactly what's in the written policy of the Reserve Bank. I really don't know how the market inferred from that restatement or reiteration of the written policy that we were withdrawing from the market altogether. So I used to agonize in those months about whether I was making some communication missteps, but later on I realized that every governor has communication problems. Bernanke writes about them in his book. Greenspan writes about them. Even Greenspan writes about them. Bernanke's taper tantrum statement of May 2013, which he repeated again in June 2013. I'm sure that he was taken aback by that reaction. More recently, more importantly, a year ago in August 2015, People's Bank of China, PBOC, they are alleged to have mishandled the communication. I met some Chinese officials after that, including the governor. They were quite baffled also about why something that was done in such good faith and explained in such straight language should actually confuse global markets so much. So every governor agonizes over communication missteps. So can we predict market reaction? I want to draw an inference from physics, 20th century physics. There were two great theories. There's the relativity and quantum mechanics. And those two theories are inconsistent with each other because relativity is very deterministic. You can precisely predict everything in the universe with mathematical precision. Quantum mechanics, on the other hand, says that the universe is stochastic, probabilistic, and all that. Einstein, all through his life, could not reconcile to the probabilistic nature of the universe. So he famously said, to assert what he thought, that God does not play dice. And Niels Bohr, a Danish physicist, a quantum mechanics, quantum scientist, told Einstein, Albert, stop telling God what he can or cannot do. So central bankers tend to believe that markets are wrong, but central bankers cannot presume to tell markets how to behave. So I'm going to conclude now. I spoke about the global financial crisis. I spoke about inflation. I spoke about the exchange rate. As Shamika said in the introduction, my book is more than about just the crisis. It's more than about just the differences with the government or the problems we had in resolving those differences. But my book is not about defending my record or establishing my legacy or reshaping the narrative. My book is about communicating the dilemmas and challenges of a very difficult period, challenges in making public policy, where decisions are never black and white, always gray. It's an effort to give my perspectives on the issues of that time, which shaped that narrative in the first place. I enjoyed writing the book, and I hope you enjoy reading it. Thank you.
Thank you, Dr. Subbarao. May I invite Subir Gokarn to comment?
I want to talk about three sets of issues which Subba raised in the book and which I was sort of deeply involved with while I was in the RBI. There was a reference to a discussion or a conversation that he had with a political figure about proteins. I think for me the important dimension of this issue was that when we started to deal with the early signs of inflation in late 2009 when I joined, food was the big driver there, and we'd had a sort of a indifferent to weak monsoon in 2009, and pulse prices were starting to climb very sharply, and we are sort of, in a sense reliving that scenario today. But I spent a lot of time trying to figure out this dynamic. Was it short-lived? Was it more persistent? And I think to me at least, the most important speech that I gave when I was there was, of course, a plagiarized title. It was Food Inflation, This Time It's Different, where we compared the persistence of food inflation across the decades and pointed out that in the 2000s, certainly after the mid-2000s, the pattern of food inflation was similar to what we'd experienced in the 60s and up to the sort of mid to mid-70s, I'd say. Long periods, average of about 36 to 40 month periods when food inflation was over 10%. So we had these runs. But in the middle period between the late 70s and the 90s, this pattern had actually changed dramatically. So we had episodes of food inflation, but their persistence was relatively weak. So you had 12 months, 14 months sort of runs. But when you broke it down into what was driving it, in the 60s it was rice and wheat. That was very clear. The whole green revolution was a response to that, and a very successful response to that. In the 2000s it was proteins, it was vegetables, not just pulses, but milk and animal products as well. And there I think is where we sort of face the big challenge, which is that there wasn't a supply response in place. In the late 60s, we had this massive emphasis on cereal production. We moved from being import dependent to self-sufficiency, and very quickly moved to actually accumulating stocks, which then became very effective price stabilization mechanisms to the extent that were used. And after that, we've had limited episodes of cereal inflation, but everything else has been driving it. So the overall structure of the agricultural system, the unintended consequences of a successful investment, a successful incentive program which we introduced in the 60s, has led, I think, to an excess production of cereal. We know this because our stocks are far higher at most times than what is considered to be a safe buffer, and the difficulty I think that we've had in transiting the incentive framework from cereal focus to everything else, and that led to the persistence. And from a monetary policy perspective, the dilemmas that Subha was referring to, some of it came from demand, the conventional excess demand problem, but even if you dealt with that, the difficulty that we had in bringing inflation down, every time you looked at the food numbers, they were just looking more and more frightening. Now those have actually eased off considerably in the last 3 years, and that's very good. But as we've seen in 2015-16, a similar kind of pressure has materialized, and although we aren't at the 10% mark yet, there is a clear sort of hardening of the process. So ultimately, this does bring agricultural policy very squarely into the whole macroeconomic management, inflation management process, and that's something that's a linkage that we have to be very, very focused on. The second issue I wanted to touch on briefly was forecasting. I think the key, this again Subha refers to the difficulty that we had forecasting our target variables. The key issue here is that a central bank, or for that matter many institutions, have to act immediately on a forecast. You can't wait for the whole sequence of revisions and changes and so on to kick in before you make your decision. And so you make a forecast based on data you have, you take an action based on it. And if it turns out that in hindsight your forecast was wrong because the data wasn't all quite there, new data comes in, revisions are coming in, and the action then turns out to have been the wrong action. So for outside forecasters, and I was in that business before I joined the Reserve Bank, I didn't have to take an action based on my forecast, somebody else had to. It was very comfortable revising forecasts. So every 3 months you'd say, well, sorry I was wrong 3 months ago, here's new data, here's information, I'm putting a new forecast. But what we used to do very diligently was to peg forecasts that other people had made, the independent forecasters, at the same time that we had made them, and then look at the errors that their forecasts involved, which is the extent to which they were revising as new data came in. And I think when we make that comparison, we found that our forecasts in a given situation are not that far out of line. Many people missed the transitions that we experienced when the inflation numbers started to shoot up in late 2010, including the IMF, by the way. So this is not just national. Many people missed the growth slowdown that we experienced based on the old series, and I'm not getting into the whole data issue here. But as people revised forecasts, clearly it started to look as though the judgments that we were making, as was said, in hindsight, we could have taken a different set of actions. But I think the judgment has to be in relation to whether your forecast was a reasonable one at the time that you made it. And after that, then the action has to be justified in terms of that number. You can't be waiting for, let the picture become clearer and we'll wait for that. One thing we discovered, I think, was, and this is referred to in one of the chapters, the analogy with the football game, the goalkeeper, is that not doing something, it's very nice in theory, that you can stay in position and try and justify inaction to the system, but in practice it just doesn't work. When there is an expectation that you have to do something, it's very difficult to put forward an argument that status quo was preferable. So that takes me to my last point, which is about currency, and really to take it back a couple of years from the taper. The taper tantrum was clearly the most intense episode of currency volatility that we've experienced, at least in my memory, and far more severe than two episodes that we had earlier. But the episode in 2011, which followed the downgrading of the US sovereign rating, and subsequently the episode in 2012, which wasn't really motivated by an external shock as much as fiscal and budgetary and subsidy issues, election outcomes, and so on, a number of domestic factors that played a role. All of those showed similar tendencies, and to me the underlying force there, apart from how you react to it, was how the current account deficit exploded during that period. And we had four clear sort of drivers of this. One was that oil prices, of course, shot up in late 2010. Before that, from 2007 onwards, our gold imports had started to climb very rapidly, and from about 1.2, 1.3% of GDP in 2007, they'd risen to over 3% of GDP in 2012. So effectively, almost the whole current account deficit was attributable mathematically to the increase in gold imports, partly value but also volumes. And then we stopped exporting iron ore. So why was this? Because the Supreme Court in 2010, late 2010, banned the export of iron ore from Karnataka and Goa. So about a $5 billion shock overnight. And the last of these drivers was coal, which we import a lot of coking coal, but historically we did not import large quantities of thermal coal or steam coal. And again, between the 2007-2012 period, we saw imports of thermal coal go up from a few $100 million at most to about $10 billion over this period of time. So we had these sequential shocks to the current account, which really were not offset by exports were growing at 10-15% during that period, I think, but that wasn't enough to offset. So as the current account deficit widened, the vulnerability on the rupee front, proportionately increased, and every time you had any kind of shock, the currency would just go completely crazy. And we saw this when we started to compare our situation with other countries. The correlation was absolutely perfect. If you were above a certain threshold of current account deficit, your currency was subject to enormous volatility. And you can see that now, when we benchmark ourselves with the rest of the world, our current account deficit now is 1.2% of GDP. We've got huge benefits from a whole range of factors, commodity prices and so on. And commodity exporters whose current account deficits have widened because their revenues have dropped, are experiencing enormous volatility and actually very sharp depreciation. The extreme is Russia, which has the ruble has depreciated by exactly the percentage that oil prices have come down. In effect, the ruble price of oil has remained constant. The ruble to the dollar rate has adjusted by that. But this trend is visible in a whole range of currencies. So I think the idea that this idea of a safe zone or a sort of limit, an upper limit on the current account deficit, which the RBI had established as 3%, difficult to justify a specific number because context change, but that was a very real kind of a threat. And the taper tantrum, let's not forget, the current account deficit was 4.8% of GDP in that year, the highest by far that it's ever been, and I think that played a significant role in intensifying the shock. The shock came, but the vulnerability was that much greater, and so the impact was that much greater.
Thank you, Subir, for those details. Ninan, would you like to comment?
When you took charge, Dr. Subbarao, there were sort of two views on the Reserve Bank. One was, and still is, that this is a highly respected institution. It's seen as an institution, one of the few in this country that works, that it's got depth of internal competence in what it does, and that it therefore compares very well with a lot of other institutions in the system. The other view, which has been articulated very clearly in public, is that the RBI is a completely incompetent body. That is one of the worst central banks in the world, that it bungles everything that it touches. If it's possible, I'd like you to sort of address these two views. I suspect you will say both are true in some ways, but if we can get a little more clarity in the way you address some of the other issues, it would be nice to see what you think. So that's one. Second is that what mystified me about the book was your complete silence about the commercial banks. You have a chapter on microcredit and on NBFCs, but you have nothing to say on the banks. And the biggest issue this economy faces today is the banks. And in a sense, the crisis began to open up and become more visible shortly after you left. It is clear that they were all fudging their books. What was the Reserve Bank doing as a regulator monitoring these banks? And the fact that you've not chosen to address it is to me a bit of a mystery. So I wonder if you'd like to comment on that particular issue. There is a view on the rupee policy which says that if you made a mistake at all, it was not at the time of the crisis, but in abandoning a long established record of a dirty float and saying let the market be, and allowing the rupee to reach levels which then cause macroeconomic problems. I don't know if you're aware of this criticism, but in any case, would you like to respond to that? The slightly unfair question to you would be, given the level of differences and the frequency on the range of issues on which you differed with the government, what was your experience when you were on the other side of the table? You were the finance secretary. You had the same minister with whom you had a whole range of problems as governor. So what is going on when, before you became governor and you were on the side of the minister? So was the relationship with Dr. Reddy as fractious as the one with you? And did it then not warn you in advance that am I getting into something which I'm not fully prepared for? And therefore, putting your issues, looking at your issues, the issues that you raised vis-a-vis the government, from the side of the person who might have been, who was finance secretary, let's say, when on the other side of the table. For instance, I've been told, I don't know if this is true or not, that there is a clear reason why some of those appointments were not cleared. One deputy governor's case was cleared as a special case, apparently because you were new to the job, you needed people with expertise, and so it was seen and stated as a one-time exception, which you could not use as a precedent for the second deputy governor being given a similar extension of term. And that, I've been told that there are some other instances in which you cited on which there is a completely different story. Now, I don't know if you're going to get that other story. Mr. Chidambaram is going to be sharing a dais with you in the next few days, so I don't know whether it will come out there. But are you conscious of the fact that while what you've said would be obviously completely correct, but there might be another perspective which puts a different light on it? And lastly, the issue that bothers me today, not about the domestic scene, but the international scene, is from the figure that I get from the Financial Times, is that 1/3 of global capital is now getting negative returns. The figure that I think was mentioned was $26 trillion of global capital is getting negative returns. Now, there have been, I think the last period when something like this happened was in World War II, which is a totally different situation. And clearly, this undercuts all logic of commercial banking. How does a bank function in this situation? And what you see across the European banks, for instance, is that they've all lost half their market value in the last 12 months. Deutsche Bank, which is the largest in Germany, is quoting at 1/4 of its book value. So the market is telling us that we have this huge banking crisis building up. And my question to you therefore is, are we into some variant of 2008, which also was caused by low interest rates or negative interest rates, and therefore the creation of the subprime market to try and get better returns, and the sloshing around of capital today going into all kinds of crazy valuations is a direct response to what's happening in the bond market. So is there a crisis that's coming up for which there isn't enough attention being paid?
On the first one, you said there are two views about the Reserve Bank. The first view being that it's got depth of competence within its domain, known for its professional integrity. Compared with its peers, it stands out. In some ways, it's the best practice in emerging economy central banks. The other view is that It bungles policy, it bungles everything it touches. And as you yourself pointed out, they're not inconsistent with each other. It can be a powerhouse of competence within its domain, but since it does so much that has to do with public policy, markets, etc., there is criticism. And some of the criticism oftentimes goes overboard about bungling, etc. Take the exchange rate crisis, for example. It is inevitable that the correction in exchange rate had to take place. Like Subir pointed out about the current account deficit for 3 years in a row, we had CAD exceeding 4% of GDP, way above the sustainable limit. A correction had to take place. So the Reserve Bank was in the forefront battling the exchange rate pressure when everybody, including the Reserve Bank, knew that a correction was inevitable. So when there was a destabilizing correction in the exchange rate, it is attributed to the Reserve Bank. An inevitable outcome is attributed as a result of Reserve Bank's action or inaction. I'm not defending everything that the Reserve Bank does. Some of the things you said about why the bond market is not developed. We used to break our heads about why indeed the bond market is not developed. And the only thing I should take credit for in the development of bond market non-development is that I did not appoint another committee. But practically everybody who came across that problem, the immediate response was, let's appoint another committee. Now, hopefully, the bond market is taking off. So, I would think some of the criticism is a consequence of the way the Reserve Bank is thrown into managing problems and crises which are not its making. Let me give another example, inflation. One of the big drivers of inflation was the fiscal profligacy of the government. And we used to point that out in the report. I used to talk to the finance minister and the prime minister about it. We used to say that in our speeches, but there's a point beyond which you cannot go. What else can you do? You cannot just shout from the rooftop that the government is the sinner. So the inflation problem or the inability to control inflation is attributed to the Reserve Bank, although not all the factors that are driving inflation are within the control of the Reserve Bank. So to sum up my response, both those views are true. They're not inconsistent with each other, but hopefully the second view will disappear in course of time. The second question about why did I not write about banks? The reason I did not touch about banking licenses as such was that I thought I had no story to tell that was not already in the public domain or did not have a new perspective to add to a story that's already there. The NPA issue is different. It's a problem that originated during my time. It grew in time and it's now become bigger than any of us thought it might be. Looking back with the benefit of hindsight, I believe that I should have addressed the problem, but that was not to be, because even as I was writing, I was not very sure that I had anything to add to the public discourse except to say that some of the causes for the crisis or for the pressure owed to action or inaction of the Reserve Bank on my watch. Except to explain or elaborate those findings, I didn't think I had much to say, but now looking back, I should have addressed some of those issues. The third point you raised is about the dirty float of the exchange rate, about whether that was a mistaken policy. I don't agree with that. I tend to view that we should move towards a market-determined exchange rate, and the less we intervene in the market, the less we try to correct the exchange rate or negotiate the trajectory of the exchange rate movement, the better. In fact, one of the dilemmas which I write about in the book a little bit is this. I was criticized for not having accumulated reserves when there was capital flow coming in during 2010 and 2011. The criticism against me and the complaint against me is that had I built up reserves during that time, we would have had a very good buffer in 2013 when we were hit by the taper tantrums. I did not build reserves for several reasons. First, because I believed that the exchange rate was adjusting reasonably smoothly without any volatility. Certainly there was no excess volatility. And any intervention at that time would have been inconsistent with our stated policy. And if we intervene in a situation which was inconsistent with our stated policy, the signal that market players, especially corporates, would get is that every time the exchange rate moves, the Reserve Bank will move in and correct for it, so we can sit back and enjoy the benefits of a smooth exchange rate and make money on that. I wanted to, as far as possible, my endeavor was to remove that moral hazard, that Reserve Bank will actually minimize intervention in the market and intervene only when it's absolutely necessary. The criticism afterwards, even today, was that we should have been more interventionist, but I believe that moving towards a market exchange rate would be good for the economy, good for our long-run macroeconomic management. The fourth question, an inconvenient question as you called it, was did my worldview change when I shifted from finance ministry to the Reserve Bank? Yes, to some extent, certainly. In the finance ministry, I was an official. I was not my own boss. There was an entire team. The government of India is a lot different from the Reserve Bank of India. Being the finance secretary is a lot different from being the governor. But a more specific issue, did I put pressure on Governor Reddy by myself or as a messenger for Mr. Chidambaram? I don't think I put pressure. But I did act differently in the Reserve Bank and as finance secretary. I'll give you one example, which I refer to in the book, about extracting as much dividend from the Reserve Bank as you can. As finance secretary, I was putting pressure on Governor Reddy and the Reserve Bank to relax their norms, transfer as much as possible to the government, whereas as governor, I resisted similar pressures. But I know you're looking for more juicy examples. On exchange rate, for example, yes. Certainly, we would tell Dr. Reddy, myself, on behalf of Finance Minister, on behalf of the government, our view about the exchange rate. But there's a very fine distinction between communicating your view and putting pressure. And I don't think Governor Reddy ever, I didn't discuss with him, but you can check with him, I don't think Governor Reddy ever thought that I was actually putting pressure on him. He might have disagreed with me, he might have been unhappy with me that Subir has been my friend for 30 years, even he's turned a turncoat, he might have thought that. But I don't think he would ever thought that I actually put pressure, in part because I was not in a position to put pressure. It's the finance minister was in a position to put pressure because he got leverage. Finance secretary doesn't have much of a leverage. So I wasn't putting pressure, but I was certainly communicating some unpleasant decisions on behalf of the government to Dr. Reddy, and I was also involved in managing some of the skirmishes between the finance minister and the governor, between the government of India and the Reserve Bank of India, but there was no crossing the border to putting pressure. Finally, about whether in managing the present macro situation around the world we're sowing the seeds of another crisis. That's always been a consistent worry. When I attended G20, the IMFC meetings, one of the constant refrains used to be, in managing this crisis, we're sowing the seeds of the next crisis. And whether we will have a Lehman type moment now. I can't say that we will not have another crisis. As you pointed out, FT figures. Somebody told me that the negative interest bond market is the fastest growing financial market in the world today. So yes, negative interest rates are counterintuitive. There's a limit to how negative interest rates can go now. Helicopter money, which we were not talking about even 6 months ago, increasingly, if you do content analysis, it's coming into play. Helicopter money, somebody might do it very soon. But I don't think we will have, okay, I don't think there are unknown unknowns today like they were in 2008. There are known unknowns, but there are no unknown unknowns. To that extent, I think a layman type moment is unlikely, but a crisis is certainly possible. Like that Rogoff and Reinhardt wrote that book, This Time is Different, 800 Years of Crisis. Their main thesis is that we never learn. Over 800 years, every financial crisis originated from the same fundamental causes. So it's difficult to say that in the 801st year, we've learned our lessons. There's going to be a crisis, but I don't think there's going to be a layman type moment. Alternate narrative, yes, I didn't speak to Mr. I met him, and he's been very, he's as good a friend of mine as he was before. And I saw that, we didn't talk about this, but I saw some press report, a statement by him that there were some occasions when he did accede, or the government acceded to my recommendation on appointment of deputy governors. I don't want to go to specific instances, but yes, I concede that point, that certain times the government did accede to my recommendation, appoint a deputy governor, certain times they did not. But that proves the point, does it not? That they were being quite arbitrary in applying the rule. There was a rule position that a certain deputy governor or a deputy governor is eligible for reappointment. They give in some cases, they don't give in some cases, acting completely arbitrarily, non-transparently, and in a manner that was not contestable. That pained me. So you can have different versions about this, and you can go on and on. Mr. Chidambaram will give his own version. Mr. Pranab Mukherjee, sometime I think he will give his own version. And I have given my version. And there are very few players involved in this, so everybody else can speculate, but there were no witnesses to these conversations. So there were only, all the players will sometimes speak up, and there will be stories we've woven around that. But I still feel that the government did extract a price for the Reserve Bank not falling in line, especially when the finance minister said that all of you who've gone from outside into the Reserve Bank have become hostage to the Reserve Bank's technocracy. And then he made a certain decision, had to put two and two together and say that they were interrelated. Thank you.
Thank you.
Subir, I've satisfied you.
Do you have a comment?
I have a high frequency of changing jobs anyways, so I think the issue of whether the current situation compares, I don't think there's any question that the global banking system is under enormous pressure.
I've seen a forecast which says at least 2 major European banks will collapse.
I won't dispute that forecast, but I think the circumstances in which we are working now are very different from the circumstances where we were working in 2008, and it cuts back to the point of unknown unknowns. I mean, look at the macro conditions in which these banks reached this point of vulnerability. Growth was good, business was good.
Yeah.
Nobody was really looking at vulnerabilities in the sense of, impaired balance sheets, because the way the balance sheets were being constructed were basically riding on new instruments where the search for return was very high, and we didn't really have any sense of what the inherent risks of these instruments was.
Yeah.
And since I'm speaking from the rating agency perspective, the collapse of the synthetics, the CDOs and the MBSs, essentially reflected an underlying kind of weakness with risk measurement. The way in which risk was being measured simply did not actually capture the intrinsic risks in these products. So if you're observing or measuring a certain risk and you're providing for it, and the risk actually turns out to be significantly larger than what you thought it was, there's an automatic sort of transmission. So all of the institutions that Subba referred to in the first 10 days of his term essentially got hit by this complete disconnect between measured risk and actual inherent risk. The situation today is that the basic business model of banks is impaired. Forget about these, balance sheet vulnerabilities, new products and synthetics and complex derivatives and so on. It's just that there is no lending going on. Credit growth is extremely sluggish. Even banks that have been forced by regulators to move back to bread and butter, deposit taking and lending activity, are struggling to find people who will borrow and pay an interest. So I think it's not the same set of drivers. It is basically a sluggish economy, whatever, however you define sluggish. And I think therefore the policy implications are somewhat different, which is in that situation you had a demand, excessive demand. You had a sort of almost an overheat scenario in most of the world. And the collapse happened because banks had created balance sheet exposures which regulators certainly didn't understand. Nobody understood. I mean, this is complete ignorance. And now you're actually in a situation where some sort of demand stimulus could actually turn bank balance, because the nature of the balance sheets are somewhat different. So when you start talking about helicopter money or massive fiscal stimulus wherever there's space, and the IMF keeps talking about fiscal space, if it exists, must be used. I think that would have if that space exists, would have a less, let's say, unpredictable or less opaque impact on bank balance sheets now. But whether that's going to happen in time to bring some of these institutions back to level of viability, I think that there is certainly a question. There's an uncertainty about timing and effectiveness of stimulus, but I don't think the solution itself is that difficult to
but who's got the fiscal space?
That's the
Debt
point.
levels are all massive.
Well, that's a huge debate that's going on. Is there monetary space? Helicopter money, negative interest rates. People are questioning it in the form of liquidity trap issues. Is there fiscal space? We look at debt numbers of most countries. But who set that holy grail? Your debt sustainability is. That's the nature of the policy debate. I think the question is, where is the space? How can we be most effectively used to prevent the banking system from failing? I think the assessments you're referring to are essentially based on the premise that there isn't the space, or if it's there, it's not being used, aggressively enough to bring the banks back to a level of viability.
Thank you. Before I open up the question answer round to the audience, I will abuse my position of a moderator to ask you a couple of questions myself. This gets down to some of the fundamentals of central banking in a democratic setup. So it seems to me like the channel of communication between the finance ministry and the RBI, it is so subjective to individuals that there are no formal mechanisms through which we can reduce some of that uncertainty. And this becomes particularly important because moving forward, there's a lot of speculation based on individuals and their own behaviors. And you started off your speech by saying there is a strong element of behavioral economics in the way you make statements. So what do you think of that? Are there ways through which we want to formalize some of this communication channels? That's the first question. Let me just... The second is monetary policy globally, we know, is fundamentally based on the forecasting capabilities of the central bank, which as an economist we are humble enough to recognize that it's very limited. We have very limited powers to do that kind of forecasting. But the RBI in particular as an institution, and Subir, of course, you were a part of this, so the question really is to the both of you, is how can the RBI itself as an institution be strengthened in terms of the research capability, just better data, so that this forecasting becomes a little more predictable or a little more, less volatile? And the third is a personal question to you, because I heard a couple of Fed chairmen speak about their tenure, and I was particularly struck by what Paul Volcker said, that he worried a lot. In fact, he worried so much he would keep pacing up and down his office. He almost worn out, he wore out the rug in his office. Is this really, does this position really worry Did it worry you as much?
Okay. First, on the communication channels, I do think that communication between the government and the central bank is a function of the institutional norms and protocols we set up. But on that, there is an overlay of the chemistry between the main actors, the finance minister and the governor. So no matter how much you try to institutionalize this, there would always be a subjective element. I myself noticed that there was a difference between having different finance ministers, between Mr. Pranab Mukherjee and Mr. Chidambaram. Although I said in the book that both of them had put pressure, but the nature of interaction, the chemistry was entirely different. So I don't believe that you can take away the personalities and the chemistry between personalities from the issue of communication and harmony between the central bank and the government. Not just us in India, even Greenspan talks about it. No? I referred to that in my book. He says that the first President Bush was miffed with him because of his tight interest rate policy. And I don't know if he wrote that in his book, but somewhere he said that all invitations to White House functions stopped during the first President Bush's term because the president was miffed with him. And he also blamed Greenspan for his election loss. He didn't get the second term. So I think these frictions between individuals will always remain, regardless of institutions. On the second question about data strengthening and all that, we do that in the Reserve Bank all the time, so we can talk about it. Professor Indira Rajaraman, she was a director on our board, and she used to ask very certain questions. We tried our best, and the Reserve Bank tries to corroborate evidence from survey results and statistical data put out by the CSO with its own variety of surveys, but there's a limit to what the Reserve Bank can do. It's a central bank, it is not a statistical agency. And the third question is, do I worry? I think worrying is a matter of personality. It's not so much a matter of the job you hold. I've seen people holding very difficult jobs not worry at all. Mr. Chandrababu Naidu was my chief minister for 6 years. I don't want to say it in public, but he doesn't. He's a very tough politician. He doesn't worry so much. He doesn't show the worry, at least. So I think worrying is a matter of personality and not so much of the job you hold.
Thank you. So,
You want me to address that?
yeah, please, absolutely.
Well, I think you recognize the limits of econometric techniques. Time series models in rapid structural change are always vulnerable. You tend to underpredict when structural change is driving you forward or higher to higher trajectory. You overpredict when you have a decline. So you recognize this. You can't do anything about it in short periods of time. So you combine methodologies. We had 3 groups of forecasters who were using econometric techniques of different kinds. The issue there was, are they all using the same assumptions to arrive at their forecasts with different methodologies? So it was very important for us to ensure that they use the same underlying assumptions, and that wasn't happening all the time. So it became a matter of great, explicit sort of attention. Lay out your assumptions first before you give us your model forecast. We'd be doing surveys. There were several business cycle type surveys which would give us a sense. I started to focus a lot on corporate numbers, top line, bottom line patterns to see whether business cycle patterns were being reflected there. And then we talked to a lot of people. We talked to businesses, we talked to banks, we talked to NBFCs at different frequencies, but all of these were inputs into a policy decision. And at the end of the day, you had either you had a sort of converging story from all of them, but then you'd have to pin your judgment on that sort of forecast number, or you'd have a divergent story where the forecast, the econometrics were telling you one thing and the other indicators were telling you something else. I think in many situations we did actually find that divergence. So there you start to make you have to hedge somewhere, and some of those baby step kind of decisions, I think had an element of hedging, because the different inputs into the forecast were actually telling us somewhat different stories.
Thank you. So now we'll take questions from the audience. I'd request you to give a brief introduction and keep your question limited to one.
Hi, my name is Ritika Mankar. I work as a senior economist with Ambit Capital. So I guess my question is with respect to the RBI as an institution, separate from the change in guard that you're likely to see very quickly at the Reserve Bank of India. What I as an economist worry about is the institutional framework of the Reserve Bank of India. The MPC comes into play, and my main worry at this point in time is, will accountability get compromised under the MPC framework? The reason why I say this, and I know that there's a monetary policy agreement which says that, if you miss the inflation target for 3 quarters, you need to explain yourself. We know historically that there's always, most often than not, been a disagreement between what the Technical Advisory Committee has said and what the governor wants. So all I worry about is, will that institution feel less strongly about inflation targeting in a group setting as opposed to the setting that we've had thus far, where one man was responsible for making sure that inflation was under control.
Thank you. Anybody else?
Pradeep Agarwal, RBI professor from Institute of Economic Growth. You talked about the exchange rate policy that under your regime, and that you wanted RBI to remain very neutral. But there were many instances, including the taper tantrum in 2013, where exchange rate went so far out of the normal range, and where I think it was a matter of foreigners, FIIs pulling out maybe 10, 15, 20 billion when we were having 300 billions in reserve. So, and under Dr. Raghuram Rajan, we have had a much more stable rupee policy. And I thought that it's not only the corporates who are we have to worry about. It's also the general public. If what happens to the petrol prices affects the entire country. So I had a strong feeling that RBI needed to be much more, you cannot control the long-term direction of the exchange rate, but you can certainly control the volatility. And there I thought that maybe more should have been done actually. I have one more question.
Very quickly, please.
Okay. If, for example, the petroleum prices go up, as they did, for example, in 2009, etc., dramatically, and the prices need to adjust, we keep raising interest rates, and that reduces our supply of goods, reduces investment, and everything else. When there is this kind of supply shock, are we not better off just maybe a little bit of action is okay, but if we excessively raise interest rate, it can be, I don't know what purpose it really serves. Because the price, if the costs have gone up, the prices have to catch up, no matter what we do. So in the end, you will have this inflation, and you'll also kill the economy, like some of the people claim about it. So I think if we had probably a more moderate increase in interest rates, it might have been a better balance. Because once the prices go up, the prices of the goods have to increase. How are you going to restrict it?
Great, thank you. So do you want to answer? These are difficult, whether capitalism is collapsing to water-intensive cropping. I think we've strayed way beyond monetary policy, but if you'd like to.
Respond to questions within the purview of the Reserve Bank. Ritika's question about whether the MPC system will compromise accountability. That's not necessarily true. It's quite possible that the MPC instrumentality might in fact make the Reserve Bank more accountable. You're shifting decision making from an individual to a committee. So I don't believe that just because of that, accountability might get compromised. The governor will still be responsible. He or she will do as much as possible to persuade the members of the MPC to his or her point of view, but eventually it's the majority decision, including the casting vote of the governor, that prevails. And there could be many arguments about the MPC, but I don't think accountability would be a dimension that I would worry about. Professor Agarwal's questions about exchange rate overshooting, exchange rate actually having an adverse impact on the larger public, etc. Certainly, I agree with that. Exchange rate is a variable that affects the everyday lives of people, so in many ways that they don't realize. I also agree that when exchange rate is making a significant adjustment, sometimes there is an overshoot, and that overshoot is harmful, but then you expect that if it's an overshoot, it will self-correct. The only point I was trying to make was that if the movement of the exchange rate from a certain level to another level is inevitable, the endeavor of the Reserve Bank should be to navigate the trajectory of the movement rather than targeting a different destination for the exchange rate. On the issue of supply shocks, whether monetary policy should respond to it, again, it's another development seminar by itself. But the only thing I want to say very briefly is that even if inflation is driven by supply shocks, the Reserve Bank does worry that inflation expectations might get unanchored, unhinged, and thereby set off a generalized inflation. So even if supply shocks are not amenable to control by monetary policy, your monetary policy has to be, most of the time, the first line of defense.
Great. Thank you. So thank you all for coming, and thank you, gentlemen, for your time and your effort. Thank you very much.
Thank you.